Stream live is okay. All right, guys, here we go. And I think we are live at this moment. I'm checking the live stream, and yeah, we're live, guys. So welcome to DeRisking DeFi, a virtual panel organized by Opium and by Andrey, and Anton is also there in Amsterdam as well. So it's really cool to that you guys can do this together. Today's we will be focused on the risks in DeFi. We have some amazing speakers to talk about all the different risks that we can experience in decentralized finance and how to mitigate these risks. We have invited the best builders of the space. We're talking with Aave, with OneInch, and of course with Opium, with Anton, and with Barnbridge. And this event is hosted on DeFi channel. And mission to bring DeFi to the mainstream. And I think de-risking DeFi is a very, very important step to make DeFi a more mature industry in general. And in around 50, we will kick off today with discussion with Anton and Andrey. And in about 50 minutes, we will have Tyler and Stani here as well. All right. Okay. Andrey, maybe introduce yourself a little bit and tell a little bit about what you have been building to de-risk DeFi.
Yep, I'm Andrey. I'm founder of Opium, and I used to be a professional derivative trader and fund manager in my previous life, in my centralized finance career. So in my current life, I built a derivative protocol with a lot of cool derivatives. And what are derivatives? Is basically the way to trade risk. So there are many risks, and they are very efficiently traded with derivatives. You can isolate any risk, you can take specific risks, so on and so on. And that's our participation in de-risking or risk splitting of DeFi.
All right, and how do you? So you basically built a whole scale of instruments that you are using in the CeFi space already. And you bridge them now in the DeFi space. It's really, really cool. And how does risk managed instruments can make DeFi more mature?
More mature simply because it's going to be a choice. It's going to be choice. It's going to be ability to take the exposure you like to take. So basically, why do we need financial system? Why do we need financial markets? We need them to be able to efficiently take an exposure, position, hedge that we need. Current DeFi looks like you take all the risks, you accept all the risks, but you don't do DeFi and you don't accept anything. So it's very difficult to split the risks. So that's exactly the reason. So we need financial markets, not because we want to have financial markets, but because they solve a problem of risk taking and efficient risk taking. So, and at DeFi it's still gonna come, because at the moment it's a lot of cool stuff, but in many cases it's all or nothing, and that needs to be solved. I think in 2021 I expect a good development.
Yeah, so I get it. And what is the most important risk types that you see in DeFi today?
Well, the most important risk is that people don't think about risks. That's really risky. So nobody's thinking. At least 90% of people, they don't thinking in terms of risk return, or what kind of exposure do I have, what kind of leverage do I have, what kind of stress or catastrophic scenarios may I be exposed to, so on and so on. And I think this is the biggest risk. So the education, let's say, or the standards in DeFi education of users.
Yeah, and basically with Opium Protocol, people that see less risk in DeFi, they can actually profit from that. If people think, there's not that much risk, people can then bet on that, and other people can bet against that, right? So that's basically what Opium.
Well, not only with Opium Protocol, they can do it with any kind of derivatives or spot instruments or underlying. So derivatives is the most efficient instruments normally to do this, but it's not only with Opium or not only with derivatives. So, but you're right, yeah. So you can just think something which is unfairly priced in, and take this risk or get rid of the risk. So both.
Yeah, exactly. And you say you can do that with other products than Opium as well.
Yeah. Every single product in Opium is about some specific risk. So if it's future, it's a risk of the future price. Option is one side of the price, so upside or downside. CDS is a tail risk, so catastrophic risk. Risk tranching, which we launched recently, is about splitting the risks into different categories, so on, so on.
Yeah, I really like the risk tranching product because when I was reading your Medium article, your previous interface was also a little bit harder to understand, and now you upgraded the interface. So it's actually really easy to understand what Opium does. And the risk tranching, as I understand, you can basically bet for or against higher or lower yield in different protocols, right?
Is it easier to use our current interface?
Yeah, it's not complicated. I found it like pretty easy to understand since you have like a few buttons. It's like easy, like read what like options you have. Like if you have, for example, to fix your interest rate on CDI, you have only one option on website currently. But I believe like you will grow number of options, number of time periods, and user interface also could expand, but you have to manage this to make it still useful and easy to understand for people.
Yeah, exactly. So we're trying to make it very simple, and for now it's few clicks, and of course it's going to be very sophisticated. It will develop together with DeFi. So yeah.
Yeah, and what I like, you also have the professional interface that will also still be maintained, right? So you have the pro version and the Opium.finance version, where basically the products are very simply.
That's funny to mention, because we have both versions and both the same under the hood. So you can trade CDS on Opium Exchange, and CDS is professional contract. You have order book, so on. Or you can just go click button and buy insurance from USDT collapse. And under the hood is the CDS, but 99.9% of the people currently use the easiest version. And I can understand, and that's actually funny. It's way of thinking. So we also need to rethink interfaces. So we're rethinking financial system, and we need to rethink interfaces, because people got used to the same interfaces. So, and
Yeah,
it's in the same basically patterns.
It's very complex material, and I think also Anton from OneInch, you also had an amazing UI upgrade where the order routes. We also talked about that before. The order routes were like really cool to see that you route the orders, but you actually make that visual. And I think a lot of more people are now using OneInch than before because of that visual upgrade, right?
Yeah. We believe it's important for users to understand how exactly OneInch got this cool price for them. The more this swap, the more roads we will check. Like if you swap super low amount of funds, like tens of bucks or hundreds of bucks, it makes no sense to split among like tens of dexes or build really complex roads, because it would cost you a lot of gas. But when you swap like tens of thousands of bucks or hundreds of thousands of bucks or even more in one transaction, it makes sense to build really nice roads. It could involve like tens of different dexes. Right now we have more than 43 integrations. And roads, it's not like when it started, it was just about splitting among several sources. But right now we have really complex roads with multiple steps, with multiple on each road. And it's really like one of the most complex aggregators on the market.
I wanted to print the map and put it on my wall. So sometimes really beautiful.
Yeah, it's amazing. I really like it. And also Anton, what you also built with the USDC to DAI swap, where basically you directly use MakerDAO there as well. So I saw that as well. It was amazing how you guys do that. And now I see you guys both in the same room. Is there some risk mitigating products that
It's 1.5 meter, so that's the camera is not so good, but it's 1.5 meters.
I know there's, yeah, I can see that there's like white space that has been cut in between, right? That's like, yeah, very nice.
Photoshop.
Very nice. Yeah, and I think for a lot of people, like 1inch it's clear, right? It's on the upper layer. It's basically just a protocol to swap assets. Underneath there's so much more to it as well. And I think also similar goes for Opium Protocol, where people now see like, okay, risk tranching or other different tools on the opium.finance. But underneath Opium, there's also a lot of cool features that people can explore. What is the something that you would like to de-risk on 1inch, Anton? What is the risk that maybe Opium could help with, you think?
Yeah, there are like few things which can be like you can consider them as risks, and you can try to mitigate them using different derivatives like Opium Protocol. I can enumerate them, try to enumerate. First of all, risk of failed transaction. This risk, it depends on how many different dexes you have under this transaction hidden, like inside the swap. This depends on how much is gas price you are using, because if it's small, you will wait a lot until the transaction gets mined, and you have like a higher risk of being reverted, and you will spend your gas on reverted transaction, which could be like tens or hundreds of bucks. This is like first one. Also, 1inch have a liquidity protocol under the hood. We released it recently with our new version. And liquidity protocol risk for liquidity providers is usually impermanent loss when they come and relative price of two assets was 1, and when they are trying to exit or withdraw their assets, relative prices of two assets is different. It's subject for impermanent loss, which will disappear if price will remain, relative price of these two assets.
Yeah.
So it's also one more risk. And when people, as far as I see this, when people do daily trading and they sell something when it's high enough and they expect it will drop in price, or when they buy something which could pump in price, I suspect this is also like a risk that you're holding something and you're afraid if it can drop in price. You can not swap and like dump this thing. You can, for example, try to buy insurance that price of the thing will not drop for a few days. So you can buy swap rate, for example.
Derivative, basically.
Yeah.
Here it comes. So that's a good explanation why actually like normal people may need derivatives. So because normal people, we don't need also derivatives for derivatives. We need to solve some specific problems, and that's a very good explanation, actually.
Yeah, that's why I'm here.
Anton, also, you are one of the best person to speak about impermanent loss, because not so many people understood it. So, and I understood it always, but Anton teach me something recently that I understand it even better now.
Yeah.
Because people don't realize that there is impermanent loss, and if you look at LP of whatever market maker, it's all nice.
Yeah, it's like there's also a problem that some people do not heard about this and they do not understand, and it's like unexpected surprise when they withdraw. But some people do heard of impermanent loss, read a lot of documentation about this, and they afraid of it, too much, because from my point of view, impermanent loss is a problem, but it's not like a huge problem for most cases. But most of the people who are aware of impermanent loss, they do really afraid of it, like if it's like 10 times more huge a problem than it actually is.
Mm-hmm.
Yeah, so basically they overestimate it or underestimate it heavily.
Yeah.
Yes.
Yeah, and I think a lot of farm products kind of capitalize on people not understanding that risk, right? And do you think we will still see? Do you think we will maybe see more vampire attacks when those risks can be properly hedged, or more like less farming, or what do you think will happen then?
Regarding the farming, the what project which like have farming, they're aiming to have a volatile token, like good enough liquidity to allow anyone to buy or sell their token. They create the farming of their token with some tokens like Ether, USDC, DAI. They incentivize people to provide liquidity of their token with some other assets, and this allows their token to be liquid. Really, this is like they pay. It's like similar to paying to market makers to have like enough liquidity and some volumes, but it's paying to people who just provide liquidity to automated market maker. It's like the same, but it's better for users because they can easily do this. Anyone can put liquidity into AMM and don't think about it. But like doing actual market making is a hard thing. So it's like project is paying for one or another, but paying to via farming is a preferred way, better way to have a good volatility, good liquidity, no, not volatility, on decentralized market. Yeah. So what projects aiming is to have a good liquidity of their token, and they set up some farming thing, and yeah. Regarding the vampire attack, it's like I did not really saw the like real vampire attack because they were not like too much vampire actually. A real vampire attack on Uniswap, for example, could be if someone would propose existing liquidity providers to migrate and would have like a list of liquidity providers who are allowed to migrate with their actual balances, not to invite everyone to this thing with like additional increased rewards, but to invite those who are actually like having their liquidity provided into Uniswap. This would be a like a real vampire attack because it will be aimed to existing users, existing liquidity providers.
Yeah, exactly. And this is just people exploring new options, right? I agree. And I think that also the DeFi space is being so collaborative that I even maybe vampire word is a different wrong wording for it, where I now see also SushiSwap or Uniswap or all these different protocols are working more and more together, and also yourself with 1inch and Opium. Everybody is working together. It's still a relatively small space, but we all very closely work together on most of it. And I really like your analogy that you made, Anton. By normally hundreds of thousands of euros are paid to like Binance or other centralized exchange for like listing fees, and then another millions are paid to market makers to actually keep the price relatively stable. That money now just flows back to the community. So that is actually a beautiful thing, and I think that's really good. We also now have Taylor ready to come on the stream from Barnbridge. I will add them right now as well. Here you go. Hi, Taylor. How are you doing, man?
What's up? How are y'all doing?
Great to see you. And yeah, happy for you to join this cool panel. We were, I think you listened in already, right? So we're discussing impermanent loss and different factors in the DeFi space. But DeFi is still very risky. So what do you think DeFi is more risky than CeFi? But before we answer that question, maybe Taylor, tell a little bit who you are and which project are you working on at the moment?
Yeah, absolutely. So I'm Tyler with Barnbridge. We're working on a tokenized risk protocol. So at a high level, we're essentially trying to hedge out the capability of market loss via market prices. So there's a lot of different risks in DeFi, like you're mentioning one, impermanent loss. There's smart contract risk. There's a lot of different risks that essentially exist in DeFi. I think when you say, is DeFi or CeFi more risky? I think some of that comes down to perception. There's a lot of like money that gets lost in DeFi due to hacks and other reasons. But I mean, the amount of money that was like lost on Robinhood in the past 24 hours where these centralized entities were able to essentially stop all trading at one point. Like they said, over 50% of users essentially had GameStop or GME in their portfolios. And so, I mean, if you calculate the amount of money that those users lost backstopping for the hedge funds, I mean, I don't know. I mean, like, and then you kind of look at what like George Soros did to the British pound, to the average like individual in Britain that weren't even involved in the markets. They just had their purchasing power destroyed by him wrecking their economy. I mean, it's kind of disgusting, but like I'm getting to the point that I don't actually know if DeFi is more risky. But yeah, there's risks associated. There's risks with anything. That, you know, there's risks if you buy a vacuum that it breaks. But yeah, I mean, I think that we're at the precipice where that's starting to shift. Whether or not DeFi is more risky, but I would absolutely be lying if I said it wasn't risky. I mean, hacks happen all the time. We're getting better as an ecosystem. I think we're collaborating. We're kind of figuring out who are the good guys and who are the bad guys and who we want to build with long term. But yeah, I mean, it's a loaded question, and I'm not sure that I know the answer. I know that I don't have a single dime of my money in Robinhood, and I never will. And I have a lot more money on DeFi protocols. So I think that if you ask me the same question in a year, I think that we'll have a clear answer. Definitely in 5. But there isn't, for what Barnbridge is doing, just to kind of summarize for everybody who doesn't know what Barnbridge is, we're essentially, it was a project that was conceived back in April of 2019. And we use the concept of tranching from the traditional markets, but we're not trying to make like collateralized debt obligations or like credit default swaps. I mean, you can do some of that stuff with Barnbridge, especially if you kind of start mixing what we're doing with Opium. You can start to create extremely cool derivatives. The good thing I think that would be different than the traditional markets is that it's a lot more transparent. But basically, if you kind of think of most of everything in DeFi as pools of money, with smart contracts powering those pools of money, like putting if-then statements in them or like more complex if-then statements. Basically, the kind of concept around Barnbridge is you can take those pools of money, split them into 1, 2, or assuming infinite liquidity, infinite parts. And you can basically say this riskier tranche treats risk and reward one way. This less risky tranche treats it another way. And being able to track that on chain, whether it's taking a yield stream and separating it out, like how it behaves between those two groups, or just tranching out just alpha risk, like whether or not something's going to go up or down in value. Both of those things are really like the two basis products that we're essentially trying to start with.
Yeah, that's really amazing. I love if people have the time, you really go to the Barnbridge Medium, medium.com/Barnbridge. I'll put it in the show notes below. And the Barnbridge standards that have came out, and I think that's also a big win for Opium Protocol and other protocols that are also building and trying to de-risk DeFi. I think it's really
That's
good.
what I was trying to say. I was trying to just come to this idea because we came together with Barnbridge and we said, hey, we are trying to do derivatives, which are cool. Okay, ideas does make sense. We're going to solve this problem, risk, tranche, so on and so on. But how many people do speak about risk? Not so much. And if people speak about risk, they speak different language, so they describe different terms. And user will go nuts understanding all this and how to compare apples to oranges and oranges to bicycle, and it's completely incomparable. So, and that's why we came together and we said, okay, we have very similar ideas, complementing each other. But the first step, let's speak the same language about risk, and let's make it voluntarily, because there is no regulator, nothing, but we feel responsibility to self-regulate and to disclose to our users, to community, at least what do we think about risk, what are the major risks. We're not going to go nitty-gritty because it's impossible now, but at least 90% of the picture you can explain with, or like 80% of the picture you can explain with 20% of disclosures and effort, and that's what we did. I don't know, Tyler, how do you see it? But I see it like this is really cool initiative, and it will be needed for DeFi to be mature.
Yeah, and I think I was actually surprised at some of like I would call them like OGs of DeFi that reached out as a result of that. I think it was one of those things that we kind of like rolled out, and Opium was amazing. I mean, this is like how I got to know Andrey, and I think he's awesome, and like, I mean, that part of it was cool, but the part of it that I really liked is that some of the people that have been building in DeFi for a really long time, they basically kind of came in and started. I mean, they reached out to me and were like, "Hey, this is really cool. Why did you do it?" And at a high level, the reason that we need standards in the industry is when people come in and build on top of like what we're building. So like me and Andrey / Opium are building on top of primitives that have come before us. Even like 1inch, right? Like they're aggregating other primitives, right? And if you think about it that way, what 1inch is doing is they're aggregating, like you could almost think of them as equities. Like every Tesla stock is a Tesla stock. Every chain link is equal to another link. But when you get into things with like maturities or probably like less liquid, what you would call like securities or derivatives, you start to run into problems where like, is everybody calling par value par value? Is everybody calling a coupon a coupon? Like, how do you know what the maturity is on these things? Like, do you read it on chain? Is it in the syntax of the actual like ERC20? Or, I mean, some of them will do them as NFTs. Some of them will do them as ERC20s. So how do you create like fungibility throughout like the ecosystem and have like standards that other people can build on top of, which like ERC20 in and of itself like started as a standard. So we really wanted to try to at least come to a consensus on like how Opium and how Barnbridge were going to call certain things on chain, so that when like, you know, like a 1inch decides that they're going to build markets for some of our less liquid things, or other protocols decide to build on top of us, they kind of know what is what without us having to build some complex Oracle system in order to do it. Because a lot of it you can just do on chain within the asset itself.
Yeah, that's I want to add that it's really difficult sometimes, even if you have standards. So let's take it a centralized system. It has standards, so I can see the bond, I can see all the description of the bond. What is the bond? And it's 100% the same. So I know the guy, he actually did lots of money. He became like multimillionaire on the following exercise. He was getting the book, describing the full full descriptions of the bond, and he was reading it, and he was finding some small thing which is not priced in by the market, so people don't know about it. Then he started to act on the market and then disclose it, and he made like really, he's a really successful guy. Just one exercise. So even if we think we know everything about bonds, bonds, it's a pretty structured, pretty great market, it's still possible. So how can you imagine DeFi right now? So it's like completely like 10,000 years still to go, and we want to start with something very simple but very fair.
Yeah, and I'm even still seeing stuff we need to add to it, but it's good. I mean, like it will help composability through the ecosystem, and I think that as more groups start to adopt it, like we're really pushing Stani to adopt it with Aave. Robert from Compound reached out to me over the standards, and I had never talked to him. So I think that if the syndicates do it, the derivatives do it, then you kind of just have to, if you want to be composable, then you've got to kind of build in these areas. And honestly, there's a lot more room for standards in the ecosystem. Like with options, like they don't all look the same. We're not even calling everything the same thing. Like Synthetics calls their options market an options market. It's really a predictions market. So, I mean, we're not there yet, but we're getting there. And I think there's a lot of innovation and capital moving into the space. And I think over time, some of these things will fix themselves.
Yeah, and then coming to the point, what is more risky, DeFi or CeFi? I would say I would rather prefer cryptographic security over like legal security, because we can see now that apparently some of the short sellers were very good friends with Mrs. Janet Yellen, and then that's a little bit interesting what's happening there. So if you actually, I think also traders will prefer cryptographic security above legal security, or maybe probably a combination of both at the end, right? And I hope to see that moving forward. And I think we're all building out the standards for that ecosystem to flourish. And what like the risk tranching, right? So maybe Andrey you can explain a little bit in depth what does that mean, because they explained that, and what does risk tranching exactly mean, and what do you do with that, and how do you cryptographically secure that?
Yeah, but basically Tyler already touched it. It's the simplest way to explain it is just a pool. So we put all the risks there in the pool, all of us, and then whoever has the senior tranche, he goes at the end of the period. There's something, we end up with something, and the first guy takes 5% return from it. Second guy takes 7% return, so on, and the last guy can take everything else, and that's very classical risk tranching. So if we have a lot of return in a pool, the last guy is really happy, because after the first have 5, 7, 8, and then there is last one, that's a lot of left, so he can be rich within one exercise like this. And if there is very poor returns, then the first guy still have his 5%, second guy still have his 7, third guy may already have problems getting 8, and the last guy may have nothing. And that's basically the risk tranching. So you tranche the risk into different categories, and it's done normally when you don't, when it's difficult to do some metrics about the risk, model the risk, where you don't understand the risk. It's a very simple exercise how you can very pretty naturally split the risk. The only thing, you need to know what you're doing, right? If those risks are correlated, then the exercise is not worth it. So that was 2008, and it was a mortgage securities there. People think it's uncorrelated, but of course it became correlated. And then the whole exercise doesn't bring you anything. So it's risk of the first guy equal to the risk of the last guy. They used to call themselves AAA and CCC, but the AAA was as risky as CCC. And that's the problem. So that's why people get critical about it. And a lot of, we got a lot of comments. We have some first simple risk tranching. We got a lot of comments, people comparing to Wall Street, crisis, this, that, and you need to realize basically that it can be dangerous instruments if you don't know what you're doing. It can be really handy instruments, like a Swiss knife. Yeah, if you don't know what you're doing, you can cut your finger easily. But if you know what you're doing, it's pretty needed. It's pretty useful.
Yeah, exactly. And do you think eventually, because also in the article on CoinDesk, it also said like Warren Buffett called like collateralized debt obligations or some other financial tools like really dangerous. But I think on a blockchain, it's more cryptographically secure, where the rating agencies cannot just say this is secure and this is not secure. You can actually inspect it yourself. Do you think traders?
It's auditable, yeah.
Yeah, right. Do you think traders eventually want that, or that they would prefer maybe the older regulated market, or they would just prefer a more like cryptographic secure?
I'm not sure that the cryptographic security of risk tranches is what makes them attractive in DeFi right now. I actually kind of think it's like a little bit ironic when people say like, "Oh, you guys are tranching stuff," so like that sounds like it could just blow everything up. But the truth is that we almost need it. I mean, collateralized debt or like mortgage-backed securities actually worked for a very long time. Like from like the 1980s when they really started getting traction, all the way up to like when they didn't like blow up until 2007. And the problem wasn't the mortgage-backed securities themselves; it was that they ran out of senior tranches, so they just started making shit up. And like that part of it. I'm not sure that it's the cryptographic. I mean, it sort of is, but like it's the transparency of it. Like they wouldn't be able to make it up the second time around because we could see everything on chain and see what was in these tranches. Like I worked in that space selling fixed income products, and it took like the bull market firms almost like 5 years to even figure out what was in those things. Like if Aave blew up tomorrow, we'd know exactly what blew it up within 30 minutes. It's not going to take that long. So like it with the transparency within DeFi almost creates a scenario where you don't need ratings agencies in the same way. I mean, I think that third parties can come in and kind of tell you what's risky and what's not, but it's never going to need to be like demanded by the government because like a lot of that you can just handle on chain. Like a savvy auditor like Anton, like he could probably figure out how to hack things on his own, right? And as things happen over time, it starts to become safer and safer and safer. But what's really interesting in my experience is, I mean, I've been like selling Barnbridge to traditional finance folks all the way to pitching it to degens, like because I want to get people to use it. And I always hear people on our side say, well, who in the hell is ever going to take the senior side of these bets? And like that part of it is ironic to me, which means like the entire industry is overexposed to risk. So it probably actually would be healthy for the industry to start taking some of these senior bets and taking some risk off the table because the market's extremely volatile. And then I talk to the traditional finance guys and they're like, who in the hell is going to take the junior side of the bet? And it's ironic to me because these people just don't have any idea the mindset of the other side. And so long term, the senior tranches will likely have more demand. They're safer. But we can price them more effectively. When we run out of senior tranches, we can, the interest rates will drop. In traditional finance, what happened with MBS is they ran out of it. The sales guys liked that coupon from when they sold it. And yeah, then they just started calling stuff things that it actually wasn't. So I think that, I think at aggregate, this will actually be very good for the industry because everything in crypto is probably should be considered junk, at least in the short term.
Yeah, I completely agree. And also at the right moment, Stani also joins in for our live conversation. And we were just discussing the risk crunching, and Taylor was talking about Barnbridge and Anton and Andrey. So welcome, Stani, to the stream. I think everybody knows you already. Stani is the founder of Aave, one of the main leading protocols with a lot of assets under management. Welcome, Stani.
Thanks, Amadeo. Did you guys congratulate the Anton already for the birthday?
Happy birthday!
Happy birthday, Anton. Yes, I actually forgot about that, Stani. So thank you for reminding me. Yeah, Anton, happy birthday. And welcome, and welcome. Happy birthday. Welcome to your new life here.
Yeah, happy birthday. And happy birthday to Opium. I guess happy birthday yesterday to Opium's token for a successful launch.
Yeah.
Yeah, that's amazing. It's amazing to see. And also talking about the risk, I think the Opium protocol and the token already like some of the risk crunch that you put out, Andrey, are already oversubscribed, right? Like on the other side of the risk. So the USD Tether is oversubscribed right now. So you need to raise that ceiling, as far as I see.
Yeah. We're gonna be happy to connect Aave pretty soon.
Yeah.
Nice. As of today, so I would like to ask you a question, right? So we saw today with the GameSpot the event that happened, right? Do you think we're living in a Netscape moment for DeFi, because people are now seeing like, wait a minute, they can just stop our protocol. If I actually use DeFi, nobody can stop me, and I can see transparently, I can see all the risk and everything that's going on.
I think, well, I would say quickly that like this GameStop, kind of like a what happened with Reddit and everything. This is amazing. Like honestly, like this is what is needed, because like there's been so long period where kind of like the whole financial system is based where you give custody to service providers, and they decide pretty much how services are rendered to you. And beyond that, there's a lot of problems in terms of like how traditional finance works. And now we have decentralized finance, which like operates in logically in a complete different manner. You're not giving custody of. You have like all the power to decide what you're going to do. Basically, you can practically swap assets, launch risk with Barnbridge, and also kind of like take risk exposure with Opium, and all of this stuff. Like it's you can decide upon that, and there's the idea of DeFi is like reducing friction on each and every deployment. It's not just like permissionless ability to build, like to participate, but also to build things, to build innovation that at the end of the day goes to the consumer. And what happened with this GameStop is that it's a kind of like a very big, like a fuck you to the traditional finance and like how it works, but how it works today. And people are like, they're not happy. And why would they be like especially our generation, younger generation, they can't control finance. Like it's their right in one sense. So people are just fed up, and this is where the frustration comes. And then you have the effects where Robinhood, which has done a lot of innovation in the front end of user experience for, where interactive brokers and so forth, they have been lacking quite substantially in traditional banks. And now practically they've closed opportunities to other people. That's how they got like 200,000 one-star reviews in their app. And then on the side, you have actually an ecosystem where things are running 24/7, unstoppable, because like those are like rights of people, like finance. Like it's just for me, this is amazing what's happening there, because like we have been doing, everyone here in the call have been doing this for a while in DeFi, like and people who are using DeFi like understand this. But now like there's actually kind of like frustrated people in the traditional like sectors and are actually like trying to show a point. So it's cool what's happening now.
What is the risk, Stani? Because it's called DeRisking. So one of the risks what you describe. I mean, I cannot be more excited about the stuff what you say, and I agree. Finance is human right, basically. But one of the risks can be that people not getting educated and jump into something which they completely don't understand. And that can be really funny. So one gentleman came to Opium. He bought insurance for 1 day, so for the order book for some nice price. And then he contacted us, said, "Okay, what is next? How can I get my money back?" I said, "Yeah, you bought insurance. Yeah, okay, fine. It didn't work out, but I want to now get my premium back." So he didn't understand that insurance is something. You pay money to be insured and so on. So it can be not funny though if people jump to something, and that's maybe I'm trying to find the risk, because I'm very excited what you're describing, but what is the risk? What we should think about the risk, right? What is the risk here? What do you think?
I think the risk is kind of like well, of course, like if everyone's jumping, at some point someone are jumping out. There's always like the market risk. But I guess like in terms of like what's risk, like in terms of like general risk, like if you compare to traditional finance, I mean, that's the thing. Like, what is the risk? Like, how do you see and quantify the risk? And I think when I was waiting in the kind of like the green room, I heard Tyler mentioning that you can quantify everything that is happening practically in DeFi, what's happening in Aave, and all these swaps happening in DeFi space, and you can actually quantify and choose like how much you want to take risk. Do you want to take the whole, like let's say if a GameStop will be a some sort of a token, you could actually decide like how much risk you will take. So let's say you don't need to take the whole risk of that exposure. You could actually take partially and decide. And I just think like in terms of like risk, what's happening in DeFi is that this all is like we can calculate this exposure. That's not the same in traditional finance, and that is why I think like when it comes to products, for example, with the tranching and also kind of like credit default swaps and so forth, where you could actually like buy insurance for your exposure and share risk. Like it's going to be very, very used product because you can do it on a smart contract level and with the data that is completely transparent in a way that you haven't been able to do ever before. And that's going to be like very game-changing moment, not just like for retailers, but institutions as well.
I also think that the way that we look at risk, like we have become reliant on these like centralized authorities that really aren't looking out for us. Like your bank account, like, yeah, you have like federal deposit insurance, but like, what do you essentially end up paying for that? Like you have to pay for it in all these regulations that are stacked against like the little person. So like one of the things about DeFi that I think like when people say that it's risky is like, I don't think a lot of people in traditional finance know how much the system is screwing them. And I think that that's starting to change. But like I tweeted recently about Aave, and it was like, look, when the large banks got caught like in these naked shorts, like that have massive downstream risk, like this GameStop thing is going to spread, and it's not going to be good for traditional markets. These hedge funds called the friends at their country club, they called the SEC, they called the head of the NASDAQ, they called the media machine, and they tried to make this go away for themselves, right? I got liquidated on Aave 2 weeks ago, and I didn't call Stani even though I know him, but because I knew what the answer was going to be. He wasn't going to be able to help me. Like maybe he could give me a loan like in real life or something if I was really like an idiot with it. But like I knew what the outcome was going to be. But the flip side of that is, so like now I have the responsibility to manage my own money more. So like, was it risky? I don't know. I actually like ended up getting more money back, and the price dropped so much I took my USDC and just bought more Bitcoin back, which was like levered, right? But the flip side of that is if I go and try to get my money out, I know it's going to be there. Like I know that like some centralized entity, I don't have to call Stani and be like, hey, your customer service line isn't like giving me the transfer. I can't pull out 100K at one time. I'm going to just hit the button and I'm going to get it back so long as I follow the rules of the loan. And a lot of this really isn't at the protocol level that it's risky. It's at the user interface level. But it's really hard to build protocols. And that's what we've been working on as an industry. Once these protocols and these primitives and these baseline things are built as an industry, there's going to be so many people that come build React apps or mobile applications, iOS apps that plug into the technologies that we've built. And all that we need to know is that this is trustlessly going to work. So on one hand of the equation, I can't go call the FDIC. I can't go call my government. I can't go cry wolf. But honestly, those people aren't really helping us out anyway. They're helping these massive bankers out. What I really want to know is when I go sell my GameStop, that I can actually get my money back. And I said it earlier, it's disgusting that people can't. And I know why. They sold reinsurance on all of those hedges. They hedged the hedges. So now when Citadel basically hedged that Melvin's GameStop position, they sold that to someone else. Someone way downstream is holding that bag. And so these people have a decision. They can either let Melvin fail and deal with the downstream collateral risk, or they can shut GameStop down for 30 days and tell us like peasants that we're not allowed to play in the same markets as them. And then everybody's going to go to DeFi, because that's why I want to use DeFi. I don't want someone to tell me when I can move my money or when I can get it in and out. I don't really want Stani's permission. I like him, but like, I'd rather just get my money when I want it.
Exactly.
Yeah, it's open permissionless finance. That's what we're building, and I think that what we're seeing actually today, this last couple of days with GameSpot and now silver being short squeezed and a lot of things. I think it's going to be a very interesting couple of weeks moving forward. What is the biggest thing we still need to build in terms of de-risking DeFi? What is the biggest holy grail in de-risking the DeFi ecosystem, you think?
It's always fiat ramps. Like, we need better fiat ramps to insurance. We probably need better like on-chain smart contract risk. Like, we need better user interfaces to explain what the risks are. Like, I mean, I think one of the largest risks if you deposit like DAI on Aave is like ETH going down, but like the average person doesn't know that. But I mean, Stani, like 80% of his transactions don't even go through his interface. So it's kind of like Zapper's responsibility to start telling people some of that stuff. And so I think the interface stuff is easier to fix. I think the off-chain insurance that needs to hedge on-chain contracts, like at the end of the day, I still can't pay my mortgage in crypto, and until I can, the fiat rails really matter. And so I think I don't know, this kind of conversion process and education needs to happen. I think that we've done a pretty good job of building protocols that function the way they need to. I mean, Aave, Compound, they function the way they need to function, but I don't think people know how they function. So that's probably the part that we need to work on.
I would say splitting the risks. I would say splitting the risks is crucial, because I want to put my money at Aave, and then I want to have not only interest from A token, from ADAI, but I also want to have exposure to Ethereum for the same capital, and maybe I want to take another risk in return. So I have my own view about the world, or my own needs to be hedged or exposed. And in order to do this efficiently, I need to use my capital efficiently through, of course, derivatives, because I'm a derivative guy. But this mechanism should be built. So mechanism of segregating, splitting, and choosing the risks you want to take.
Yeah, I think so as well. And what is for you the biggest risk that still needs to be mitigated from Aave, or maybe something that you would like to mitigate or like to display better in Aave, Stani?
Well, I think honestly, like the being able to kind of like buy insurance, the very point you deposit is very interesting. Kind of like that. Like Aave has this safety module that is covering, backstopping the protocol, but basically it's in native Aave. It's kind of like a solution, but also like especially for institutionals, they really want to. I mean, institutionals don't really care about 6 to 8% yield. They actually they're fine if they get 2 to 3. Like they're like, I mean, they will be celebrating there. They will be like, I mean, if they get that yield, they're super happy. Like that's what they need. That they can show good numbers in balance sheets, and if they can do it on scale, and to do it on scale, they also kind of like they basically have to mitigate their exposure in terms of like risk that they're taking. And so if they can insure, let's say 100 million. Let's say worth of USDC when they deposit, that's pretty scalable for them. Of course, there's other things that that they could get fixed yield, but they're able to move capital as well. So that's probably one of the things that is quite interesting. And also the second thing is that many institutions, for example, they're coming from let's say they're holding Bitcoin. Then they're practically wrapping the Bitcoin, and those wraps, there's this a bit of custody risk there. And ensuring that is quite important. So there's a few things there, and of course, like where they're storing the assets as well. So let's say if they're storing in a custodian, that risk is there as well. So all of these risk elements, there's multiple of them, and they kind of have to. There is actually it's opportunity actually to sell them insurance, whether it's custody, the wrapping, custody, and then the actual deposit yield. So if after all of this process they just yield a couple of percent, that's a big win for them, because they can allocate capital in low interest rate environment, and also they can hold, let's say, tokens in a custody safely. So it's there's a lot of opportunities there. I think it's just like solving the scalability of insurance is important, and I think it's a liquidity question. I think Andrey knows it better than me, but I guess like there should be like counterparties who sell the insurance and so forth on that scale.
Yeah, we made a first pool. It was incentivized by liquidity mining. It was hard cap. We reached it very fast. And now people actually, they won't realize, but they will have 11% interest in USDC without any farming even. They will have 11% from the buyers of this insurance, and then on top they will have farming, but that's a different story. So that's already quite, I would say, good yield for the risk. And if you can combine it with other yields, so because we're planning to use USD, what it is, AUSDC for the collateral and ADI for the collateral, then they're going to have 11% from writing risk insurance. They will have some percent from A token, and maybe Opium liquidity is not needed anymore. That's basically the game. So they need to accept several risks on the same capital, as long as those risks are not correlated, not dependent on each other. That's pretty cool. That's increasing your overall risk return.
I also want to say shout out for making that product, because like we didn't add tether to our original yield farming pools, and it's because like I don't know when tether is going to become untethered, but like at some point I would assume that it would on a long. It's like, what are they saying, Fight Club? On a long enough timeline, the lifeline of everything goes to zero. But I think that lifeline's a lot shorter for tether. But there's a lot of people that have complained about that, because like even though we did it for risk, people still use tether. So if we're going to use tether in our actual products and let people like deposit tether on platforms, I like that. I mean, we had other ways we were going to go about trying to fix it, but I think what Opium released is very elegant, and we can just let our customers decide, or like we don't have customers, not even a company, but let our users decide if they want that covered for themselves. Then it's not our fault if they don't buy it.
Yeah, and I also really like your asset risk map, Stani, that I see. Would you see maybe an additional column in your asset risk map? I will link that in the links below. Maybe of like how much it is insured, or how much it's hedged by people.
Yeah, and I definitely agree. Like I think that part is now like somehow like we need to somehow think like how this whole insurance thing works, because obviously the safety module is just a backstop, but like how we can create an environment where inclusively you can tranche different risks, because the idea of the Aave protocol and the Aave community is to be kind of like as inclusive as possible. If you have some sort of like a de-risking mechanisms, for example, how you could, let's say, buy insurance from Opium or tranche your risk with Barnbridge and so forth, or even like in terms of like DEX aggregators, like how we can make this like that every community can somehow contribute to the Aave protocol and bring efficiency and value. And when it comes to, for example, the risk part, that is the next thing like we're trying to solve, like how we can actually solve, because end of the day, like I think the risk game will be very much about like liquidity and the pricing, and like where do you, like when there's like a lot of funds, like where do we get those counterparties who are actually taking the risk transfer and making it in scale and pricing it and being it available for the Aave depositors. And that's like the next kind of big thing. And it's not an easy job. I mean, it's not an easy thing to solve this liquidity thing. It takes a bit time to form.
Yeah, that takes a lot of time from, and I think the standards built together by Opium and Barnbridge, work together with Aave and 1inch. Basically, what we all have in this room today will drastically make this space, I believe, over time, more trustworthy than CeFi, and I think that must be our goal. We can actually prove that we can build a system that is better and more transparent, where people can feel free and don't feel upset. And if people feel upset, they can actually vote in a governance proposal to take away that pain. So that I would really like to see that. And we're almost 1 hour in, guys. So we're gonna wrap it up. And maybe Andrey, you have some final words for the DeRisking DeFi platform. You have anything you want to?
Anton want to add something about smart contract risk. He was hinting me.
Yeah, we're not yet discussed. I would like to dedicate a little bit of time about smart contract risk, because this is what we saw in 2020. There was a bunch of smart contract hacks. No one expected that this could happen in 1 year, but we saw maybe more than 10 hacks, and millions of bucks were stolen. Some of them were returned back by hackers somehow. It was different situations, but some of the funds were completely lost, and it's also a matter of time. Will anyone find these hackers or no? Because evidences will kept forever on the blockchain, and I would like to see in 2021 that protocols would allow people to hedge their smart contract risks. So they should simply allow users to bet against protocols they use. If you are using some DeFi protocols, you for example, you have your money in these protocols, like liquidity provider or anything else. If you would bet against this protocol that it will be broken, you will effectively hedge your smart contract risk. This means if this smart contract will be hacked, you will lose all your assets or part of your assets, but you will win this bet. So I hope to see this, because as Andrey said, the worst thing in DeFi that most people do not understand what risks they are exposed to, and when they will realize all these risks, some of them would decide to isolate their risks. So, for example, if you are trying to earn APR and you are exposed to holding to a risk of holding this asset, which have a super huge APR, you don't want to be exposed to risk of smart contract could be hacked. So yeah.
Yeah, exactly. And I think it's, how can we make DeFi more anti-fragile, I would say, right? I think over time, the more smart contracts we will audit as a community, the better it will become, right?
Yeah, but it not depends on audits. How some of the hacks showed, even if you have top-notch auditors, your smart contract is not perfect, and there's no proof that no one can break it. Even if it have some formal verification, this depends on what formal rules were defined. Because if you will not define all the spectrum of all the possible rules, it's still possible to be hacked. For example, example I could provide that Uniswap version 1 is pretty old and sounds like there is no bugs in it and it could not be hacked in any way. But it was hacked once when token was in ERC 777 standard. It was in BTC or something like this. They just not expected when they did some semi formal verification, they did not expected that token could do something inside own transfer method, but it was. And yeah, some pools on Uniswap, one pool was hacked. Those who had MBTC, which is ERC777, yeah, it happened more than 1 year ago. Yeah, but it was, the like one of the most reliable projects with immutable smart contracts. Uniswap version 1 was once, one of these pools was once hacked because implementation of token was not like expected by developers of protocol.
Yeah, I definitely agree what Anton says. I mean, it's kind of like people take very much granted of third-party security audits, and the quality difference between auditors, but also like audits are not like it's basically a kind of like a additional wrap to kind of like ensure that you have more air pairs in your code, and then practically formal verifications. Anton said that it's what you verify. So you kind of have to find those things that you want to have extra assurance. But actually, like the security is built internally, with a good team and procedures, and there's always an issue in DeFi that you have to keep rate of innovation very high constantly. That you can put products out into the market at the right time, and at the same time you're balancing with security. The thing is that kind of like you can't compromise security, because once it's compromised, it might be done in terms of like reputation and trust, and it's one of the difficult jobs in the whole space is to deploy secure code. It really requires a lot of effort there, and I think just like the issue is that space moves fairly quickly. But the good part is that many of these protocols and code bases are becoming libraries. So they're so often used, maintained, widely distributed, and widely maintained. They're becoming more and more secure because more people are looking at the code and improving it. But still, whenever there's new code and changes, it's always like very challenging. And probably that's why DeFi rates are high, but also it means that DeFi is not equal in the sense how people treat security, and it's DeFi is kind of like at the same time it's a playground, and at the same time people are trying to do serious business here, and it's kind of like it's a nice combination, but also it's kind of something that everyone needs to understand and educate themselves about. And at some extent, cool thing about you can build protection features. For example, what I liked about Andrey, your the kind of like a launch is that there was like actual limitations how much you can deposit, and it was gradual the increases. You can build those kind of like safety features into the protocol, which is a pretty cool thing to do.
Yeah, basically.
More. Yeah.
So
hey guys, I gotta hop. I hate to do this. I'm like late for another call that I double booked, but I'm gonna go. I just want to leave by saying everybody buy silver. You have a moral responsibility. You want to see risk, moon silver, and see what happens to the traditional markets and what happens when they go unpegged.
Thanks, guys. I just want to add one thing about smart contracts. It's basically, Stani and Anton, what you said, it's two different things. Audit is like, I have a car which is on the street, and I'm trying to put alarm system and another alarm system and another alarm system, and there is no guarantee that it's not going to be stolen. Absolutely. So I'm just trying to put extra alarm system on the time, and I say, hey, how much you have? You have 5? Oh, I have 6. So it's cooler. So, but still, it's not impossible. So it's possible to steal it. And what we're trying to think differently, insurance. So I can also buy insurance. It's going to cost much cheaper than those 5 alarms. And I know financially I'm insured. And if it's stolen, I just get my money back. So that's two different approaches. So I think it should be a healthy combination. I'm not saying one is good and one is bad, but it should be both. And at the moment it's not, of course. So that's what I hope for 2021.
One more thing regarding what you said, that the number of this security systems could make your insurance cheaper.
Well, of course, if you
Yeah.
have zero, also if
Yeah.
you put a key on the door, of course it's gonna cost very expensive.
Yeah, this also means that there is a possibility that someone who gonna sell this insurance could offer private audits, and they will be like more exposed and earn
More motivated, more
they-
financially motivated.
yeah, they will have larger stakes because they will think that they have like less exposure to this risk because they have like some security audits which is not disclosed to all the market. So it's possible case. It's like interesting to see will it happen or not. But maybe we'll never know.
But this is combination. So I think combination is stronger than doing one thing. You can only insure, and then indeed you insure some shit code and it's exploded, or you can audit it 1,000 times, but it's still possible.
Yeah, and also security auditors could also work with those who sell this insurance.
Yeah.
To be also responsible for what they do.
But that's again sharing the risk. So they share the risk. So with each other. And
Also,
yeah.
You could also buy an insurance for algorithms that are not public. I mean, that's one of the things, because if you look at some of the algorithms that, for example, 1inch has created, I mean, that's the practically best algorithm, and it's practically something that's it's very precious, but you can't have it public in one sense. What I understood, that could be one thing where you could have insurance actually, because like I mean, if I invent a algorithm, like that's the problem with decentralized finance is like pretty much like you put a lot of effort in research and development, and you put code public and out there, and it can be grabbed by others, and you lose this kind of like a competitive edge. So with insurance you can actually solve these kind of things and make them efficient. And yeah.
Mm-hmm.
Yeah.
I really like that. Oh, sorry, go for it.
Yeah, there is like actually a huge problem because all this industry, DeFi, is really about transparency. But when you also is responsible for building own business, you're responsible to investors, to token holders, to everyone who is like related to the project. And there are like some parts of the system which should be open source, like have disclosed sources for sure. Those parts which are like security and safety sensitive, so that anyone could verify that it's safe to use these smart contracts. You can't have closed sources and show some audits that sources which are hidden is good enough. it's crazy. For sure, like significant part of source code of smart contracts should be open sourced, but you can have something like algorithm on backend which works off chain. It could be open source, and it could be also a competitive advantage of your project, of your company, which your company could be backed by investors, by token holders. And transparency is a good thing, but you also want to have like competitive advantage to keep all this value on your company, because I really like competition when competitors invent something and you have to improve every day to build something new, and users sure win from this. But I'm not sure like 1inch is going open source all the stuff we have, because this could lead to value loss to existing investors and token holders. Like project could cost like 10 times less because of this, and I'm not sure this would really help users, like they would actually benefit from this. I see like there is a way you can open source everything. Someone can easily copy and modify your copy and try to improve, and then users would benefit. But this is like whole ecosystem users. It's not really about those who believe in your project, those who like have tokens or who was an investor or something like this. Yeah.
But also, like I think like something like homomorphic encryption, where basically you can protect data, but then you can allow computation on that data. That you can verify how, let's say, an algorithm works without exposing the efforts of the algorithms could be like a solution.
That's a safe calculation, basically.
It sounds like ZK.
No, that's a safe calculation. So basically, it's kind of mathematically, it's two sets of the, let's say, simplify numbers, and there is a relation between them. So you can do a calculation here, and you have a result. And if you do calculation with the corresponding numbers here, you have a result. But you can not disclose what your actual number. So that's used a lot by Israelis when they're gonna give information away, and then it's calculated and get back. They know the answer, but who does the calculation? He doesn't have a clue what he's doing.
But it could actually be interesting because
if we're talking about 1 inch, the result is verifiable. So we're showing the road, how exactly funds are going through all these protocols. It's like multiple roads with multiple steps in each. And you can easily verify that we found something, some way. I'm not sure it's possible to prove that this is like the best possible way. But that's what 1 inch is trying to achieve, the best possible way, taking gas fees into account. This is also like really matter. And it's not possible to prove that this is the best way. But if you have like a list of different DEXs with different prices, and you have this 1 inch result with shown road, how exactly your funds is gonna go over all these DEXs, and you see that result is much better than on each separate DEX, it's like up on you to believe, is it like the best or not the best? Is it good enough for you to swap with this rate? Yeah,
I agree.
Yeah, you can still inspect that yourself, basically, right? I think with open source, closed source, it's a very interesting discussion. What I saw for Synthetics, their product is now so complex, it's kind of unforkable. It seems parts
Let's
of it.
make it our. It's kind of like Joe that it's like it's very complex, but also like, I mean, honestly, like some of the protocols are super complex. It's just like, I mean, it's not it's not easy to deploy some of the stuff. It really is complex. So I can imagine, and yeah. But some products are super simple. If you look at, for example, Uniswap, it's just like it's very simple, and yet you can do innovation there. I mean, I think, for example, Anton and Uniswap was innovation from that. And there's just like with a simple stuff you can actually innovate quite a lot and create pretty cool things. Actually, I mean, AMMs is one of the kind of innovations in DeFi, and there's still like there's still a lot of work to do in the pricing, because like different assets have, I don't know, Andrey, this is actually interesting for you because I think you have an order book, right? And pretty much like AMMs is a bit different thing, and you come from traditional trading background where you actually understand like what means efficiency, high frequency, and various different kinds of products. I don't know, how would you feel about AMMs versus this order books, and where do you see order books in the future?
I see order books in the center of the market in the future, basically because it's the only way to connect different market makers. So there is not a single market maker, and Stani pointed it, that there is improvement on Uniswap comparing to Uniswap, for example, but it's just improvement. You can do another fork of Uniswap and make it more efficient on the bullish market, and another fork which is much more efficient on the bearish market, and another fork which is 90% is much more efficient and 10% loose. So you can make as many different market makers as you want, and they will have certain, let's say, specific or view or work in a better, work better in specific condition and worse otherwise. So, and that's how it's done in traditional finance. It's a lot of market makers, algorithmic trading, everything you can imagine, and they all need to communicate to each other via orders, and orders come one after another. That's you cannot put 20 orders in a room. You need to know who is the first and who is the next in order to match. And that's where order book is coming. That's basically the bottleneck of the whole financial system. So all these different characters of the market makers, algorithmic trading, hedge funds, and other participants can only speak to each other versus line of the orders, and that's basically it. The line of the orders is an order book. So that's how it is. And I think it can be reinvented. So with IMMs are good for now, but not for the rest of the life.
Well, I want to hear Anton's opinion, because Anton practically, you guys innovated on AMMs, and
And here's the opposite opinion. So Stani is trying to make a fight.
Yeah, I will teach you how to use AMMs right way, how to cook AMMs. Okay.
Sure.
Exactly. I also think AML. I think Andrey is a bit too traditional. Maybe not.
I think there is like a huge room for having AMM here for insurance thing.
Yeah, I think AMM insurance will be a really big thing where you can do long shorts on AMMs and where you can make them more efficient. And yeah, I think they are definitely here to stay, in my opinion. And I really like your analogy, Anton, with the smart contract audits, that you can then, if you buy an audit, they need to stake it. Yeah, I really hope to see that as working because I think while you bring up the smart contract audit, we have been very lucky in DeFi a couple of times because the space is pretty small, but now it's really growing much bigger. So we need to have these risks very, very well in place. So very, very well.
Amadeo, you know what I really hope to see, that huge sellers of insurance, they pay for system audits.
Let's think about it.
Yeah.
Yeah.
That's
Sounds cool, really.
So
that sounds really cool.
Smart contracts.
Yeah.
Okay. Yeah. Okay. Good.
Yeah.
Are you going to provide insurance for contracts? I mean, that could be.
I don't. Stani, it's just like Aave. It's fully decentralized.
It is. Yeah.
Yeah, that is really cool. And I also think we eventually will also look into like real world assets and stuff. Like I also already see that overspill with some products that do money markets, and then instead of like there's Crescovin, for example. Actually, Stani told me about them. They're using smart contracts in their like real world like fiat money markets, using smart contracts to make data flow more efficient and sell stock. So like I really look forward to a world where we also see more real world assets on chain, also insured by DeFi and CeFi, like more and more combined. So I hope to see that moving forward. Yeah, and I like your analogy, insurance companies paying for audits. Yeah, let's see.
Yeah.
Gonna be very interesting. All right, yeah, guys. So we're in a long talk. Any more closing remarks from Anton or Andrey or Stani? Maybe you want to have.
Let's say happy birthday again to Anton.
Yeah.
Happy birthday, Anton, and welcome to Amsterdam. But unfortunately, we have an evening clock now, so there's not that much to do now in the Netherlands. But yeah, let's hope that's gonna open up soon again, and then we can throw a big birthday party also after the evening clock.
Yeah, I also have to return home in 40 minutes.
Oh wow! Okay.
Yeah. What would happen else?
They
You're
shoot you
flying
down. I don't know.
You take your from Moscow, you come to Amsterdam, a safe place, and then you have an evening clock in Amsterdam.
Yeah.
It's interesting times here. How is everything there, Stani, on your side? Everything okay?
No, it sucks. It's lockdown here in London, complete lockdown. Like it was more fun when Andrey was here. we actually
Yes.
went to a Russian banya here in London. No, actually, we didn't go to banya. You went to banya because I had a hangover. Yeah.
So you want to drunk basically. But you should know that the banya is the best healing from the hangover. Let's go to banya. It's the best medicine.
Nice, guys. All right, let's close the live stream, guys. So yeah, thank you very much.
I'm still on air. Oh, sorry.
Yeah, we're still on the air, Andrey. So let's go the live stream. Okay, thank you very much,
It's good,
guys.
Stani, that you did not speak about the previous day.
Yeah, luckily. Yeah, so let's regroup and let's do this these kind of live streams or catching up definitely more often. And I do really think we believe, especially now with GameSpot, as Stani said, we're living in very interesting times. And yeah, let's see if more short squeezes from some other hedge funds will explode. Let's see how the centralized financial ecosystem will react. And I hope because of maybe something interesting happening there, more and more people want to be educated into DeFi and what we can do as a space. And yeah, looking forward to the future. And
thanks so much, Amadeo, for hosting.
Yes, thank you very much as well, guys. Thank you, Stani. Thank you, Andrey and Anton. And thank you, Taylor. Very cool.
Yeah, bye-bye. Thanks. Bye.
Bye-bye.